Nolan, very good to see you. We are diving into the headlines today. The subprime auto loan crisis is flashing consumer stress signals. We're going to break down what that means for investors. Auto loan delinquencies and repossessions have surged to their highest level in 30 years. Much of today's trouble stems from risky loans originated back during 2021, 2022, when stimulus programs and forbearance temporarily inflated credit scores and encourage borrowing at artificially low interest rates. So, what's new here? What's going on?
Yeah, I think Erin, thanks for the question. And what's new, or I guess the notable thing that's occurring is the U.S. is going through a period where we are having a high spike in auto loan delinquencies. This is mostly concentrated to the subprime market, just meaning the loans themselves were a little riskier to begin with. But this is starting to spike up to levels that we haven't seen. I mean, obviously since 2008, but there have been other recessionary periods since 2008 that this number also kind of spikes a little bit prior to that. So it's maybe something to pay attention to. Repossessions now exceeding levels prior to, or exceeding levels more than prior recessions, as well as car payments, I think averaging near $750 per month currently.
And I touched on it, but let's do a deeper dive. What caused this?
Yeah, it's a lot of pandemic era stimulus. When we all got
Yeah.
the extra money into our bank accounts, we could spend a little bit more, and maybe that was for down payment to a car or an extra payment here or there. Paused loan payments, student loan payments were a big one. Low interest rates during that time period. Everybody kind of had a false sense of stability during that time period. Many people took out car loans during that time period and cannot refinance them now because the interest rates are a little bit higher,
Right.
as well as some what are called layering financing mechanisms. So we had some people using abnormal loan mechanisms to get car loans or to purchase cars, home equity loans, using banks or credit union dealer loans. So you're starting to see some of these off the wall loans that we don't normally see in a healthy economy.
And of course, this doesn't happen in a vacuum. A lot of other industries are going to be affected. Can you talk through how this then is spilling over into lenders?
Yeah, subprime auto lenders are going to be the ones under most strain. There's a Texas-based subprime lender called Tricolor, which declared bankruptcy recently
Oof,
because
yeah.
they were very exposed to these loans in particular. So you can see this chart. It goes up over time. Obviously, auto loan debt balance, as cars become more expensive, you expect this line to go up over time. But I will say that the 10 or 12 or 13-year period, basically starting in 2000, there wasn't very much auto loan debt balance that was going
Yeah.
up. It was kind of paid off over time, and we've really seen a spike the past 10 or 12
Mhm, mhm.
years.
Cars are also getting very expensive. I think I was just reading that they're like $50,000 is the average price of a car right now. Uh,
Baseline, right?
so I think a lot of us then hear this, Nolan, and are wondering, is this systemic?
Yeah, and systemic just meaning like, will it impact everybody? I don't think so. Like, usually something like this is isolated to a subsector. This one in particular is within subprime loans, but there are triggering events that things like this can cause. So if there's banks or regional financial institutions over allocated towards these and they're linked up with some other assets at the same time, there could be triggering events. So it's something just to pay attention to, but at least right now it doesn't seem systemic.
hmm And because this is your world, how will this affect investors?
Well, what we're looking for as investors is, what do we do with this information? So what we're trying to do is avoid regional banks that are overexposed to these loans in particular. You can often look at audited financial statements to see what types of loans these banks are actually issuing, as
hmm
well as making sure that if you are investing into the auto sector, you usually keep your investments into the auto dealers that are those who require higher credit quality, or primarily cash buyers for their automobiles instead of those that are taking out loans. Those car companies will be a little more stable. And then, of
hmm
course, this will increase the demand for used cars over time. That subsequently, it makes used car retailers a little more attractive. And if you ever want to talk about those, we can get into a deeper dive, but that's a little more meat and potatoes than we have time for today.
Yeah, but Nolan, I'm really glad that you brought this up. It's interesting when we kind of get to take a look under the hood, a peek at the economy, and recognize that it really is all interrelated. If somebody wants to talk through the headlines with you, make sure that they are positioned well no matter what happens moving forward. What's the best way to reach you?
Sure. So they can call us at 616-301-2581 or go to our website, which is cornerstone-rp.com. And there's a contact us box at the bottom of that homepage.
Great. Nolan, thank you.
Thanks, Erin.